Everybody, my name is Neil Craig and I'm the Regional Manager for Auckland Business. Thanks for taking your time out this morning as we try and get an understanding of what's going on with the economies over the next 6 months, which has been a bit of a challenge for businesses more recently. As business owners, you're dealing with change like never before, changing customer behaviour, disruption to supply chains, volatile export markets and changing government support measures. And wait, there's more. We have an election looming in about 10 weeks. At the end of the day, information or data is key to getting a grip on what the future holds. And that's why a lot of us are devouring media like never before and absorbing an extensive amount of research that the experts are providing. At Kiwibank, we want to play our part in helping you better understand what lies ahead. The purpose of these webinars is to give you some insights into how our Kiwibank economists are seeing the future. Now more than ever, economists are playing a valuable role in helping us get our heads around a changing marketplace. And we're very fortunate at Kiwibank to have a high caliber economics team led by our Chief Economist, Jarrod Kerr. He's been in the position for about 2.5 years, joining us in March 16, and having spent 16 years overseas working in banking and finance in Australia and Asia. He's a master's degree in applied economics and finance, and a keen tramper, conversationalist, and has a black belt in karate and other talents. We're fortunate having Jarrod on our team, and I'm going to hand over to him now.
Kia ora, and thank you very much for joining the call this morning. It's been a couple of months since we've done an update like this, and a lot has changed. We're in one of those worlds which are very fluid. The title of the presentation today is Markets Fueled by Copious Amounts of QE, and I think the central bank and now government mantra of whatever it takes is going to be a theme that we will, I guess, integrate into our economic landscape for years to come. We've had a huge economic shock, and both central banks and governments are doing what they can to get us out of this. And one of the main themes, I think, in financial markets and asset markets in general has been the buoyance in equity markets, the huge amount of money being poured into fixed income markets, and how that is pushing other money into credit markets and even eventually housing markets. And I think it's a tool that central bank believes works, and it has proven to work as we came out of the 2008 crisis, but it is one where we may end up testing the limits as to how much money can a central bank print. But what is interesting is the last time we did an update like this was just after the May budget, where we congratulated the government for its bold steps. We'd already congratulated the central bank on slashing interest rates and starting up a QE or LSAP program. But now we're looking ahead, and basically both the central bank and the government has a lot more work to do to ensure our recovery. But the good news since May has been that our local economic data really has improved. As we've come out of lockdown, we've seen a huge spike in spending across most categories in New Zealand, which is fantastic. So locally, we're a lot more optimistic than we were 2 months ago, but internationally, things have gotten worse. The virus continues to spread. The economic outlook has worsened, and well, that brings me to the first chart, which I'm sure you've all seen before. The bubbles, the recorded number of confirmed COVID cases continues to climb, and we're seeing the outbreak continuing to spread in large parts of the world. Whereas New Zealand, our little old bubble of 5 million is rather pristine and an oasis of elimination, and we really do stick out for that reason. So that's a positive in terms of what we can do locally, but it's also a negative in that with the spread of the virus continuing the way it has, we're going to have to keep our borders closed to foreign tourists, potentially students and others, for a lot longer than we had estimated previously. So it's a bit of give and take when we're looking at the economic numbers at the moment. We've got weaker trading partner growth. We've got a much slower return to normal for a tourism industry, and that weaker global growth will play on us via our exports and other measures as well. So the IMF recently revised their growth numbers for the world down, and they had thought that global growth would fall by about 3% this year, which is quite a fall. Now they've revised that to -5%. It doesn't sound like a big difference, but when you're talking global output falling by 3%, actually no, falling by 5%, that's a huge difference. And most of that extra decline has come out of advanced economies, but also emerging economies are being hit pretty hard as well. And what's important about this chart here is it shows it's not a pure V. Like China's as close to a V-shaped recovery as you're going to get. The others sort of look like a V that doesn't quite get there for a few years, and that's bang on our expectations for New Zealand as well. If you look at that blue line at the bottom, you see there's quite a sharp contraction in economic activity, but from there it takes nearly 2 years to recover. And when we compare that global picture to New Zealand, we've got the makings of a V, but whoever was writing it sort of passed out at the end, and it doesn't take, it actually takes, 2 years for us to get our level of output back to where it was at the end of 2019. So we've had a huge contraction. Our economic activity will fall by about 8% this year, which is the largest we've seen since the Great Depression. But from 2021 and on, it's going to take us well into 2022 to get back to that level of output in March 2019. So there is a very long road ahead for New Zealand, and this picture here is one of the best you'll see globally, because we've contained the virus. We're back to 95% output, and it's still going to take us a few years to fully recover. That contraction in economic activity has and will continue to cause significant disruption. In terms of what the growth numbers look like, the previous chart was levels. We're going to see some wild fluctuations in the data. We're going to see, GDP growth for the second quarter contract by anywhere between -16 and -20% on a quarter, which is amazing. But then as we're going into the third quarter, it looks like the bounce back is going to be much sharper than we previously thought, and then we'll bob along in 2021. The main point with this particular chart here is I'm comparing it to what we presented you in May, and that smaller chart up on the left-hand corner shows you our central scenario, but also the downside scenario, which was much worse. This time we've updated our forecast to be slightly better than that central scenario we showed you last time. The key point there is the downside risks to our growth near term have receded, and I think that's a big change in mindset, and it's a change in mindset that all economists are going through right now in New Zealand, and it's a real positive, because if we look at our unemployment rate, this is where the full impact is displayed. The chart on the left shows our thoughts that unemployment were going to hit a little bit over 10%, but hey, there is a downside risk here that we see an unemployment rate getting closer to 15%. That was the real risk for us at that point in time. Now we've updated our forecast just a little bit to say, well, actually unemployment rate might only go into the 9 9 to 10%, and that upside to the unemployment rate we're confident won't happen. In fact, we've got a quicker return to full employment in our forecast than we had just a few months back, and that's a real big change in our bias and in our weightings on risk scenarios. What it means for housing, well, again, our old forecasts and our forecast today haven't really changed, but the risks around those forecasts have. The downside risks where we could have seen a 15 to 20% fall in house prices, we've stepped away from. We don't think that's likely. And our central scenario where house prices fall by 8-9%, we're still sticking with, and we're sticking with that fall because we still expect the unemployment rate to go from, being around 4% to getting up around 8, 9, possibly 10%. And when you see that sort of disruption, that sort of damage being done to a labour market, it does play its way through into housing. Although you'll see in our forecast here, it's a relatively short-lived dip, but it is a dip of 8-9% nonetheless. With all of that going on, inflation in this country is headed towards zero. So we have weaker economic output, we have a rise in unemployment, and we have a housing market which looks likely to come off. When you feed all that into your model on inflation, it looks like inflation is headed lower. Lower wage pressure, lower pressure, and that from coming out of petrol stations with weaker oil offshore for a while. All of these things are feeding through to a inflation outlook which is pretty weak. We're gaining spare capacity here. So I think that the inflation numbers will continue to ratchet lower. We had a nice pickup to 2.5% at the end of last year. It'll be around 1.5% when the numbers come out today, and it will continue to decline towards zero by the end of the year. The real risk here is that we actually have a short period of deflation next year. So when you think about what the central bank is here to do, well, they have an employment mandate that's not being met, and they have an inflation mandate. Again, that's not being met. So from a central bank's perspective, there's still plenty to do to try and get the economy back to where it needs to be to fulfill their two mandates. I went through that chart last time. One of the big pluses that we're starting to see coming through is the spending from the government, and this is very important. The government, should they deliver on what they say they're going to deliver on, we will see a huge fiscal impulse. So into next year, into 2022, the money that the government is injecting into the economy will show up as about a 6 to 7 percentage point increase in growth. So there is a huge fiscal impulse coming through from the government. The details of this we went through last time, but I want to highlight again that this is exactly what you are supposed to do in a crisis, in a recession that we've gone through. So we will run deficits for many years, and we will rack up debt to levels we haven't seen in a long time, but none of this concerns us. This is exactly what you want the government to do, and our net debt position is incredibly strong, and we're going from around 20% net debt to around 50-55% net debt. Most countries around the world, all developed countries around the world, would love to start at 50% right now. They're all headed towards and through 100%. So relatively speaking, we are still very well off. And to make sure that the government has the ability to execute this sort of spending and this sort of increase in debt at record low interest rates is where the where the RBNZ's large scale asset purchase program comes in. So what do we think the RBNZ is going to do from here? Well, they're going to keep interest rates, we believe, at 25 basis points well into August 2022. And I think at the earliest, we will see, hopefully, a situation where the central bank will look to unwind some of this extraordinary measures that they've implemented in 2022. But it is not a discussion for this year, definitely not a discussion for next year. If anything, the risk is that we see another outbreak in New Zealand, community transmission. We're forced to lock down parts of the economy, and if we're eventually forced to lock down the whole economy again, well, then we'll go into a double dip recession. That'll be the W type recovery that people are wary of. In that world, thoughts of negative rates become reality. If we see another double dip in this country, I would not be surprised if our central bank entertains negative interest rates, which is a fascinating development in itself. And what that would mean is wholesale interest rates in this country go negative. So there is a government bond curve, and the central bank is buying government bonds to make sure those interest rates are very low. If the central bank was to cut the cash rate into negative territory, take it from plus 25 basis points to minus 50 basis points, then we would see almost the entire government bond curve trade negative. So a 5-year government bond would be at minus 30, minus 40 basis points. 10-year government bond would be at around minus 25, minus 20 basis points. Now, what that means is our superannuation funds, our insurance companies, our banks, our asset managers, anyone who currently has to hold government bonds will actually pay the government for the privilege of holding those bonds. So the government asks for $100 and gives you an IOU that says, I'll pay you back in 5 years. You say, okay, thank you. You give them the $100 and you get $99 back in 5 years' time. And that is not unusual anymore. We've seen that overseas for the best part of 10 years. On top of the government bond curve, there is a swap curve, which is used for hedging mortgage rates. The 2-year swap rate, I believe, would fall to minus 25 basis points in that world where the cash rate's at minus 50. There's always a bit of a spread above government bonds. What that means is the mortgage rates that are priced off those rates will come crumbling down. So if the central bank found itself in a situation where it was really trying to get us out of recession, then yes, we could get into a negative world, and that would be a world where both retail deposit and mortgage rates would fall closer to zero, but definitely not through zero. To get retail rates, I think, through zero, you really need a negative cash rate of at least 1%, and I don't think they're that brave. In fact, I think negative rates is probably the last tool that you would use as a central bank. The three ahead of it, continued quantitative easing, continued LSAPs. I think we can easily get the central bank to double the amount of quantitative easing that they are currently doing, buying more government bonds, buying more council bonds, expanding the assets that they're willing to purchase. But then a surefire way of lowering lending rates throughout the economy would to be providing a term lending facility to the banks. They've done it overseas in Australia, I believe in England, and also the United States, where the central bank provides a facility that the banks of that economy can access, provide them with cheaper funding. Therefore, the banks have less reliance on wholesale funding and retail funding, which are quite expensive, and you go straight to the central bank, get cheaper funding. If that was the case, then mortgage rates, business lending rates would drop substantially. And if you look at Australia versus New Zealand right now, unfortunately the same banks in most instances, you can see that a cash rate in Australia is 0.25%, cash rate in New Zealand 0.25%, lending rates in Australia at least 80 basis points lower than here, and that's mainly because of that term lending facility that the RBA offers the Aussie banks. And another option for having a play in financial markets would be to try and stay on top of the Kiwi dollar and try and guide it lower, and that would be FX intervention, and that's simply selling Kiwi dollars that we can print as many as we like, sell them at a price that we think is too high, and buy a foreign asset at the end of it. It's been done before and it was successful. They can do it again, but it's not something that you can actually influence to an extent of what the Swiss tried to do, come out and say, we want the Kiwi dollar at 60 cents to the US. We simply don't have the ammunition to do that. But to come out and say, you know, we're at that sort of 66, looks like we're going to 67, we want to try and hit it down towards 65, I think is very doable, and that might be a tool that would at least add some downside risk to the currency when we need it. So there is still a lot that the central bank can do, and I think we'll see a lot more action out of them in the next year. And what that means for the Kiwi dollar, it's a little hard to guess, to be honest. We have a forecast of 67 cents by year end. That hasn't changed. We made that call before the pandemic, and it looks like it's still holding. The issue here is New Zealand looks relatively attractive. So does Australia, believe it or not, to the rest of the world. So the Aussie and the Kiwi dollar have both been well supported by money trying to get out of parts of the world that are really hurting during the pandemic, trying to look for yield, trying to look for an alternative. And Australia and New Zealand is a great alternative in currency space. But I think the risk to the Kiwi is that, yeah, we get to about 67, we're going to have a leg lower next year, in my opinion. It's inevitable. But if all goes well, if we are in a good world where we're all recovering, then the Kiwi will continue to glide higher and probably end into 2023 higher than what we are today. The big negative is negative rates. If we were to come out and say we're going negative at a time when the RBA refuses to, so does the Fed, so does most central banks with common sense say we don't want to go into negative territory, and New Zealand did, then that would put huge downward pressure on our currency, and that might be the method, that might be the genius behind Adrian Orr's thinking. If we did that, then our currency, I believe, would fall into the 50s and probably down towards 50 cents. So I would be sort of watching out for that over the next year or so. Any thoughts of negative rates becoming reality, the first place that it will play out is in our currency, and we'll see the currency get hit very hard. So just to give you a quick update, sorry, on our local data, we showed you this last time just as we were coming out of level 2 and into level 1, and we'd seen quite a decent spike. Well, we've been really surprised at just how high credit card activity, debit card activity, spending in our economy has held. We all expected some sort of sugar rush out of lockdown. You know, we were trapped inside for a long period of time. We rushed straight back out to our favourite restaurants and bars and cafes. And what we've seen though is the spending in the bars, cafes has actually held at a much higher level than where it was leading in to the lockdown. Our online purchases have also, I think, structurally lifted to a higher level, and they'll stay at that higher level. There's a lot of people out there who'd never purchased anything online before, all of a sudden have found convenience and found maybe even a greater source of shopping opportunities. So I think that part's structural, but the fact that we're still supporting local restaurants, bars and cafes, I think is fantastic, and it doesn't look like that's going to turn south anytime soon. And what is surprising is that we're still spending a lot of money on hair, beauty, clothing, and even pets. There's been some good articles out there around people buying pets before the lockdown and a lot of people buying pets after the lockdown. I think a lot of us spent time at home and said, how do we make our home life a lot more fun? And well, buy something furry that runs around, and we've seen quite a sharp spike in pet purchases, which is it's kind of cool. I think that's pretty cool. And in the process of buying a pet, most of us, not everyone, likes to put a fence around. So we've seen hardware DIY spending on the house itself increase, and quite a lot, and across the board. So we've gone out, we've bought ourselves a new couch, we've bought some hardware to fix up bits and pieces that annoyed us during the lockdown, and some people have even gone out and bought pools and other large ticket items. So I think now we're much better able to handle some time in lockdown because our houses are up to scratch. But the level of spending across all of these categories is much higher than we anticipated, and is holding at that higher level for a lot longer than we thought. So this is a real positive for our recovery, the bounce back that we're having. Petrol surprised us. We didn't think petrol would bounce back as much with more people working from home, etc. But has, and that's with a lower price. So in terms of volume, we must be buying even more, taking some trips around New Zealand, going above and beyond what we normally do. Alcohol, butchers, obviously a spike beforehand, actually returning back to more normal levels now. Online entertainment, I think anything online's had a structural shift, and we'll see a greater level of online activity going forward. The one part that hasn't recovered is the movies, the cinemas. I think Netflix has really taken a decent chunk out of going to the movie cinemas, and potentially people buying TVs and setting up a media room at home will also eat into that. Great thing is that sporting events has bounced back, and I think a lot of us are going to sporting events just for that, for the heck of it, right? The fact that we can. Flights, accommodation, recreation, very mixed, to be honest. Very hard to get a handle on. Flights looks like they've bounced back, but that would be, I think, turning international flights into local domestic flights. Hotel and accommodation seems to have spiked quite high, and anecdotes that we're hearing is it's actually hard to get accommodation around the country, which is surprising. And recreational travel has bounced back to normal levels. So all of this, from our point of view, is a very, very positive development from where we thought we would be two months ago. And when we look at housing, most people's largest asset, there are three pillars that we talk about. The first is, well, what's the cost of leverage? The cost of leverage has gone down substantially and will stay low for a very long time. I find it hard to see a situation in which mortgage rates rise materially in the next 2 to 5 years. And on top of that, there's been a 12-month removal of LVR restrictions. That was to help people who wanted to take on mortgage deferrals but didn't want to end up in that high LVR space. But it also is enabling first home buyers and a few others to actually come into the market as well with a lower deposit and get the foot on the ladder. The other part, which I think is the most critical, is the fact that we've got a chronic shortage in housing. So yes, we're calling for house prices to fall in the next 6 months, but there should be a decent bounce back. I think the housing market is reasonably well supported because we're simply in short supply. The population is the interesting part of this. We've seen a spike of people coming home and a drop in people leaving as basically migration flows are falling towards zero. How that plays out in the next few years, I think, will be very interesting. But if we look at the last 10 years, we've gone through the largest migration boom this country has ever recorded. We're still trying to deal with that, let alone whatever migration comes in going forward. So, mortgage rates lower. That's a good news story. That's something the RBNZ wants to see and probably wants to see more of, to be fair. Lower mortgage rates definitely supports the market. And what we've seen out of the REINZ, the data came out yesterday or the day before, is yes, we saw a sharp decline in sales as we went into lockdown. Came out of lockdown, sales bounced straight back. So there was a lot of pent-up demand over that lockdown period. We as a bank had to deal with people who were supposed to be transferring properties during lockdown. Sales that were supposed to occur during lockdown all got pushed out to the end of lockdown. So there was just a bit of transferring. But also, as we came out of lockdown, people were actually pretty excited to get back into the market. Interest rates were lower. LVRs were removed. We saw record volumes of inquiry coming through Kiwibank out of lockdown, and no doubt that that was also driven by the quite aggressive strategy of Kiwibank on the interest rate front. But we've seen these numbers here are across the whole market, so that bounce back in activity is really positive. We're wary as to how that plays out over the second half of the year, but the signs that we've seen so far have actually been very strong. So what do we expect to see, across the nation? Well, Auckland and the regions were performing incredibly well up until this year, and we will see, I think, a slowdown in the regions, Auckland coming off before bouncing back next year. Shall we open up to questions there, Neil?
Yeah, thanks, Jarrod. I've got a couple of questions. First one from Gordon. How does New Zealand's personal and private debt and government debt look compared to international economies?
The private debt is actually reasonably high. So household debt measured against income or other measures, around 160%. That is high relative to other nations around the world. So the debt in this country is very much in the private hands. Public, however, is the opposite. The level of debt New Zealand holds on the Crown balance sheet is actually very low. So this net debt target that they had of 20% of GDP, both governments trying to stick to that, but now they've allowed themselves to go up to 55% of GDP. I think 20 was too low, was too small a balance sheet for a government. I think moving up to 50 is a lot more realistic, and it's a lot easier to get the infrastructure needs done, to get, to build the health education systems that we need So I'm a lot more comfortable on the government leveraging up, but yes, we need to be wary of the amount of debt that we have in private. And I think I know where you're going with this. A lot of what the central bank is trying to do is actually get households and businesses to take on more by putting the cost of leverage lower across the system. So it is a good point.
The next question in a similar vein, talking about the crown debt and how that's increasing. What risk does this extra crown debt add to our attractiveness to international lenders? And what effect will this have on our interest rates we'll need to pay on our debt?
So my opinion is not a lot. And it's because we're starting from such a low starting point. So because we are AAA rated under Moody's, so within the top 9 or 10 countries in the world that manages to have a AAA rating, and we're AA plus in under Standard & Poor's, like the United States, and that I think we are still 2, maybe 3 rating handles above the United Kingdom, for example, who had a double notch downgrade with Brexit. So compared to Germany, yeah, we look a little worse. Compared to Luxembourg, yeah, we might look a little worse. Compared to Singapore, maybe we look a little worse. Compared to everyone else, we look a lot better. Actually, the level of German debt still at least 65%. So where we're starting from is a very, very strong starting point. What our interest rates will be is very low for a very long time, because we're actually at the start of our quantitative easing. We haven't done quantitative easing in the past like other central banks have. Our central bank is in the process of buying half of the bonds outstanding. When you take half of the duration out of the market, there's only so far that interest rate can go, because you find yourself in a market where there are already few players, but there's less duration to buy. So the whole idea is to get people into the other assets. So the central bank, in my opinion, can keep government interest rates very low for a very, very long time.
All right, thanks, Jarrod. If anybody does have a question, please just send it through on the live Q&A. Our next question comes from Basil. How is the manufacturing sector performing after COVID?
From what we've seen so far, and we haven't seen a lot, mainly anecdotes and a little bit of data here and there, confidence has definitely returned. The ones that are able to re-engage in their supply chains pretty quickly have bounced right back. So most of the companies that you'll speak to that aren't directly in tourism, accommodation, or commercial property, which seem to be the hotspots, really have bounced back. If they were strong businesses to start with, linked into strong supply chains, and with a good customer base at the end of it, we've seen most of these companies bounce right back. And the survey that we did of our clients, including a few manufacturers, the level of optimism really had exploded in the last couple of months. We were quite pessimistic during lockdown, as you can imagine. Now that we've come out, a lot of companies have gone back to work. Okay, this feels as close to normal as I felt in this world, and some companies are coming back to us and saying we're actually doing better than what we were pre-lockdown.
Okay, the next question comes from Paul. Where do you see the residential house construction over the next 12 months?
Yeah, excellent question. I think the projects that have been committed to will get done. It's the next 2 or 3 projects that may come into question in a falling house price environment. But personally, looking through the next 12 months, which may be a bit awkward, there is still a huge undersupply of housing across New Zealand. So there's still a large amount of catch up we need to do as a nation. And if you're involved in this space, well, there's a lot I think you and your colleagues have to do, and that's quite simply, we've had this large migration boom. The black line, the demand for houses, the more people that come into New Zealand and the fewer people that leave, means we need more homes. But the supply of housing really has ramped up in the last few years, and it's been quite solid increase in supply, still well short of what the country needs. And there's an interesting discussion around, building mansions versus building $500,000 affordable dwellings and the problems with doing that. But that, I think, is where people like yourself can really contribute to getting rid of this problem of a chronic shortage of affordable dwelling. So yeah, there might be some hiccups, there might be some fear. The house prices are falling, let's stay out of the market for 6 months. But if you're able to look through this, I think you'll wake up in a year or two's time, chronic shortage is still there, and the housing market in terms of price would have bounced right back, and we'll still have the same problems, right? We still wouldn't have built enough.
Thanks, Jarrod. And the next question, are there any new sunrise industries appearing or any sunset industries looking to be under the pump?
Well, the sunrise industries, I think, are the ones like this. I've never done a Teams presentation, a Zoom call, or these sorts of communications, and I think that these are fantastic. You can plug in almost as many people as you like. It's going to change the way that we work. We're going to be able to work from home more, not completely offset going into the office, but we're going to be able to work from home more. So I think the digital space, the digital economy, we were on a trend to more online working, more online purchases. That trend was happening anyway, but I think we've just fast forwarded a lot of what we were going to do into a 6 months period. So I think the sunrise, those industries were already rising, but it's just like we've gone into full daylight almost straight away. A lot of that sort of stuff is being fast forwarded. The sunset, I'm really worried about the length of time it's going to take to get foreign tourists back into this country. It's at least a year. I don't know any company that can sit there for a year without income. So I am worried that we're going to lose capacity, great companies over the next year. And when a vaccine comes, or we manage to figure out a way to get tourists down here without threat of the virus, that we've lost a lot of the operators, we lost a lot of our capacity. And I wouldn't call it a sunset industry, because I believe that New Zealand will remain on people's bucket lists. And if anything, New Zealand Inc., our label has actually strengthened. So I am actually quite worried about that tourism and hospitality part of our economy, because I just don't see an end in sight at this point.
Okay, the next question comes from Simon. Do you have any general thoughts on the sentiment of savers with regards to investing in a low interest rate environment?
Yeah, it's a hard thing doing what we do, where most people tell us we want a lower interest rate, and we know that from an economic modelling perspective, as you lower the interest rate, the net impact on an economy is positive. So central banks are all sitting there with the same playbook. Things go wrong, let's slash interest rates to zero. Well, Adrian Orr's talking about slashing rates to negative if need be. It's the same playbook. It's the one tool they know works. But every time you cut an interest rate, those of us with mortgages, we smile. Those of us saving for our first home or living on our savings as retirees, well, you suffer immediately. And my father's a classic example, myself versus my father, a classic examples of that. I quite enjoy a lower interest rate, whereas my father, when he retired, and that was before he retired in 2007, he thought, fairly enough, that he would have 5 to 6% on his money for the rest of his life as his worst case scenario. Now he's lucky to get 2.5%. So the impact on the older, I guess, retirees is severe, and at a time when they're coming into a lot more costs. So yes, it is a real problem that needs to be balanced the best we can.
All right, the next question. Infrastructure companies are starting to see the end of projects with nothing new in the pipeline for the next 6 months. This is also evident in the building sector. What impacts will this have in the short term as we go through to the end of 2020?
Yeah, and we are hearing the same anecdotes, especially in commercial space. I think the shock of the pandemic has really got a lot of companies thinking about their costs, got a lot of companies thinking about their floor space. Do we really need 1,000 square meters of space, or can we try and squeeze our operation into something a little smaller? Most of the accountants and lawyers and firms that I've spoken to have had this conversation about trying to downsize their premise. When everyone's doing it at the same time, I imagine there's going to be a fair amount of lease space pop up in the next 6 to 12 months. What does that do to construction? Well, whatever you've got going now, you pretty much got to finish. But as you say, it's the next, and I've heard from a few builders that a couple of their next 2 or 3 projects look like they might be falling over. So that's what happens in a recession like this. There will be a period of sugar rush, which we're going through, where these guys are actually trying to get projects done as quickly as possible. But then I think it's actually going into 2021 where we might see that dip in construction activity over probably the first half of next year, and then I think hopefully over the cycle we start to bounce back as these people find other projects, as other projects that were potentially priced out of a market come in. I don't think we're in for a deep recession here. I think we're going through the correction that is almost inevitable.
All right, we've got time for one or two more questions. What is your view on the health of the SME sector over the next 6 months? Do you expect the levels of consumer spending to maintain the high levels and support of much of that sector?
Yeah, it's a great question. And like I said before, I think we are legitimately a lot more upbeat about our domestic activity and outlook than what we were 2 months ago. And when it comes to all of these charts that I'm more than happy to send to you all around levels of spending, I think a lot of this will be maintained. But what we're trying to figure out is, as we went into lockdown, we spent a lot less. As we came out of lockdown, we found ourselves with a lot of extra savings. We noticed within the bank that the level of bank accounts had gone up. So I think people are running those back down. They're going out and buying this, buying that. Where we get a little nervous is actually in September. So I think we'll hold for another few months, but it's actually in September when the wage subsidies come off, where a lot of the mortgage deferrals will come off. We'll happily put people back on deferral, I think, but it's still that signal where we might find that's exactly when the lift in unemployment comes, is when the wage subsidies finish, and that may occur at a time when more stresses are coming onto the economy. So the short answer is yes, I think these levels hold for a while, but we are quite wary of a spike in unemployment and what that will do to general confidence and consumer spending in the later part of this year. So I think, yep, the outlook is definitely a lot better than what we thought it was 2 months ago, but we're still very cautious of the damage that's been done and how lasting it will be. So cautiously optimistic, and beware of that rise in unemployment later in the year.
Great. Our final question for this morning, and going back on those negative interest rates, will the Reserve Bank ever go into negative interest rates, and will we have an inflation scare possibly in the future?
Well, I think the only inflation scare we will have is to the downside in the near term. So that's what keeps the central bank willing to do more on the policy front. If we wake up and we're in lockdown again, and it's for more than a couple of days, like we're talking another month or two, I think the second lockdown, however it looks, will be far worse than the lockdown that we had, the first proper lockdown, because businesses, people are starting in a worse position. And I think the economic impact of another lockdown will be far worse than the first. So that's where that V-shaped chart that I showed you before becomes a W, and the second leg of that W is worse than the first. You're a central bank, you're already failing on your employment mandate, so you've already got an 8%, 9% unemployment rate. You go into another double dip, you're now talking 15, 20% unemployment. You go into a double dip, your impact on inflation, the other mandate has also just been squashed, and the threat of deflation, intensifies. You're going to put your foot down on whatever tools you've got, and one of those tools is negative rates. So I have a 30% probability of a negative rate in the next year. So it's not immaterial.
All right, thank you very much, Jarrod. Just to close off today, thank you all for joining us. Really appreciate the questions. And if you'd like to contact Jarrod directly, kiwieconomics@kiwibank.co.nz, or you can follow them on Twitter @kiwieconomics. And a copy of this presentation will be available after the close of the presentation today. Thanks very much for joining us, everybody. Thanks, Jarrod.
Thank you.